Buying a home in 2020 can cause some serious anxiety.
I'm not gonna do what you all think I'm gonna do, which is just flip out.
As if our country isn't going through enough, as is, making big financial decisions like this can leave you with gut-wrenching feelings at times. That's why I wanted to share with you a couple different tips on what to expect during the pre-approval process, when you should actually begin the pre-approval process, and if you stay tuned through the end, I'm going to share with you a couple tips and strategies that every single financial institution is using. In fact, this is going to be the easiest and cleanest way to get a pre-approval, landing you a pre-approval 10 out of 10 times. So stay tuned. Hey guys, welcome back. Hopefully you've been safe during these trying times. And as for the mortgage industry, well, it's been one wild ride so far. But we've been doing our part, putting out small fires, bringing awareness such as forbearance awareness, rate volatility awareness. And as we are aware our economy goes through these shifts, we also understand that lifestyles are also going to be changing as well too. So if you're new to the channel, consider subscribing and tapping that notification bell as we share different market updates and home buying strategies every single week, just like this one. So let's start with the sensitive subject right now, employment. Right now, I'm sure a lot of you guys are aware, unemployment rates are going through the roof. In fact, it's closer to 17 million, and that number is anticipated to reach roughly around 20% of our working force. That's super important for buyers to know. Why? Because where lenders are at, or at least where banks are at as far as guidelines, they see the same data, so they start to prepare as far as guidelines and maybe even what's called overlays in addition to how they're going to be writing their mortgages, or at least how they're going to be offering their products. So here are a couple of examples of the changes that a lot of lenders and even banks are making in today's market when it comes to employment. So for example, if you are self-employed, you must document that the business is still active and open and that the borrower, being you, is still receiving a positive cash flow. For example, bank statements will show this, showing income coming in, such as invoices, even Google searching showing that the business is still open. These are some things that need to be met. Also, if you're self-employed, they're going to be looking for a year-to-date P&L, profit and loss statement. This is not something that needs to be filed with the IRS, but they want to see the trend of your income during this whole pandemic that we're in right now. If you're experiencing any type of loss of revenue, or if there's a decline in revenue due to COVID, the income cannot be used. So that's super important, especially if you're self-employed. If it cannot be documented that the business is still open, then the qualifying monthly income must be reduced by 25%, or 12 months of a principal and interest, taxes, and insurance needs to be in reserves. In other words, you need to have enough money in the bank that's not going towards down payment and closing costs that could continue to make your mortgage payment, or at least the property obligation payment, for the next 12 months in the event that you have a decline in income due to COVID. So these are just some of the examples as far as some of the changes that lenders are making during this whole pandemic when it comes to employment. Now, another example would be is if you were pre-approved originally and during your current employment, maybe things have changed or shifted. Remember, lenders are looking at a 2-year history. So if you've changed jobs, that's okay. You don't want to change industries. Changing industries can cause an even further delay because an underwriter, a lender, a financial institution needs to see the consistency in that same niche, in that same industry, if that makes sense. So if you are pre-approved and you decide to switch jobs or change jobs, make sure you're in the same field, you should be fine. So here's an example of what I mean by that. I had another gentleman that was a security guard, and he left that W-2 job to go into becoming an Uber driver. And most Uber drivers, they're 1099 contract workers in that sense. Well, the problem with that is that he went from W-2 style income to now 1099. And where anything that's 1099, bonus income, or commissions, an underwriter is going to use a 2-year average for that. So if we don't have 2 years of 1099s, or if we don't have 2 years of commissions or 2 years of bonuses, they're not going to be able to use that income altogether. So it's important that even if you're going to be changing jobs, try to stay in the same line of work if you intend on buying a home within the next 24 months. So some things also to consider when it comes to getting pre-approved, or at least knowing the expectations are. A lender's going to want to review your assets, or at least know where your assets are coming from. And what I mean by assets are down payment, money in the bank.
Yo, show me the money!
What do you have to apply towards your down payment stroke and or closing costs? If you are solely relying on programs like down payment assistance because you're a first-time home buyer, you want to have a more conservative approach when utilizing these programs and products. As of right now, a lot of them are suspended and some of them can't even be accessed in the sense of rate locks, which means they can't be closed upon on. So if you're relying on a down payment assistance, again, I'd be very conservative as far as being your main source of assets for down payments. You can also expect a good lender to review your credit profile. And it's not necessarily your credit score, but also the payment history. Considering what's going on right now in today's market, a lot of individuals may find themselves falling behind on maybe car payments or credit card payments, things of that nature. And that's expected to happen when you have an unemployment rate of 17 million. The point to that is you want to tread carefully with that, in the sense that if you have the funds to pay it, obviously make those payments. Even if it offers a solution to where you're not going to be behind on your payments, such as a forbearance, some of these things can jump and nip you in the butt later on down the road. One of the main focuses that a lender is looking for is to make sure that there are no past dues that are still open on whatever those trade lines may be. That being said, when they run in their findings, they're going to get verbiage called approve eligible or approve ineligible, and or the one that isn't said in the industry, refer ineligible. The credit profile may jar some of this automation where you would go from an approve eligible status, now you're approve ineligible, and probably scratching your head wondering why. I would focus on the credit profile. So to prevent any of that, if you are in a situation where you can continue to make your payments, please do. Please do, because as I mentioned before, things like a forbearance or just falling behind on payments to pay them at a later date, it could slow you down, if not bring you to a complete halt when it comes to the home buying process. And that brings me to when you should actually begin to apply. A lot of this is going to be personal based, but if you wanted a professional's opinion as far as the best times when you want to apply, you want to be about 90 days out from when you actually intend on putting in an offer on a home, or when you intend to actually be out of your current living situation. You want to give yourself the most allotted time to make informed decisions that are related to the market, such as prices of homes, where are mortgage rates at that time, and considering our current market, what are current programs and guidelines that are available to you and your family. This also gives you plenty of time to build that rapport with your home buying team, such as your preferred lender and your preferred real estate agent. Now, obviously, some families are going to be in a completely different situation in different markets like New York or New Jersey or Boston, where they're trying to hightail out of there as soon as possible. And to that is completely understandable. But nevertheless, be safe and Godspeed to those families. And as promised, I'm gonna give you guys the #1 strategy that I, as a loan originator, I've been using for the last 14 years, what every single financial institution should be using to get their buyers into a pre-approval status as quickly and as clean as possible. So that being said, I want you to go ahead and take this time to grab a pen and a piece of paper. This way you can jot some of these notes down, and when you're having that conversation with your preferred lender, you already know what criteria you're going to meet. I'll hold while you do so. No, seriously, go get a pen and piece of paper. I'm gonna hold. Pause this video right now. Okay, great. Now that you have that piece of paper, I want you to write down on this paper from top to bottom, and I want you to start with 3 letters. The first letter at the very top, I. I would represent income. Every single lender is gonna have their criteria for income. You wanna be anywhere between a 38% debt ratio and a 50% debt ratio. I'm gonna show you how to calculate that real soon. Underneath that I, give it about 2 different spaces or so, or a little bit of space, about 1 inch or so, 2 inches. And I want you to write the letter C. C for credit. Every single lender is gonna have their own overlays, and right now in today's market, there have been some pretty radical adjustments to government loans such as VA, FHA, and USDA, especially in the credit score requirements. Most products are requiring at least a 620 and above credit score, and that's going to be pretty tight to get to. So ideally, you want to be around a 640 plus credit score. Now I want you to go 2 spaces underneath that C, and I want you to write the letter E. E represents equity, which is also another way of saying down payments in this scenario. Most lenders or financial institutions have access to first-time home buyers programs that offer low down payments, like a 3.5% down for FHA or a 3% down for Fannie Mae's Home Ready program. Now that you have all 3 of these, you can see that it spells out the word ICE, I-C-E. And that's the best way to memorize what exactly a lender is going to be looking at when it comes to the pre-approval process. The first thing as far as income goes, you want to take anywhere from 38 to about 45% of your gross income. So best practice, 2 different ways, but I'll give you the short ways of doing this. Look at your W-2 from last year, divided by 12, and that's going to give you an average of what your income is going to look like. Whatever that amount is, divide that by 45%. That's going to be ideally the max housing payment, or at least max payment you could afford for all your total debt. So whatever that number may be, you have to fit your mortgage payment into that, the property taxes into that, homeowners insurance into that, and any debts that reflect on credit, such as auto loan payments, credit card payments, education loan payments. These all have to fit inside of that number. So it's an easy way for you to figure out, okay, what is going to be my affordability range that most lenders are going to be looking at. Now, when it comes to the credit profile, you can check different types of websites like Credit Karma or myfreecreditreport.com, but please check this with a little bit of caution. When you start working with a financial institution, their credit profiles are going to be different than what you see on one of these online credit services. And the main reason being for that doesn't mean that Credit Karma is wrong or myfreecreditreport.com is wrong. It simply means that they're using a different algorithm to give them different data. Versus where lenders, they all run the same type of algorithm, and it's based on FICO scoring. And I won't nerd out on you as far as all those different algorithms and the names of them. You're gonna notice a difference. I've actually spoken to a young lady not too long ago where on Credit Karma, her credit score was 700 plus. And by the time she actually went through the application process, she found out that her true score through a FICO scoring system was closer to the 650s. And so there was a huge variance there for her. So it's important to know at least what's on your profile, but take anywhere from 18 to 25 points off of that if you're looking at Credit Karma. I'm not saying that's going to be your true score. I'm just giving you a best practice to be conservative in the event that you wanted to start the pre-approval process. And then lastly, being equity assets, down payments. We touched on this before, what they're looking for. We want to make sure that we know where the funds are coming from. So if you have a 401k right now and you're pulling some funds out of that, I actually made a video about that, and you can actually find it right over here, where I talk a little bit more about what lenders are looking for in the event that you're pulling money out of a 401k. Lenders also do accept gifted funds, gift from family members. So if you intend on, getting money from mom or dad or an aunt or something of that nature, then there are going to be a couple steps that you want to take. So make sure that you have that conversation with your financial institution, but more importantly, have an idea of what that number is going to be. Do not go into the pre-approval process with the hopes that mom and dad are going to give you 10 grand, only to find out they're only able to help you out with maybe 2,000 or 2,500. It's important that you have that step at least identified. It doesn't mean that if you are pulling gift funds or from a 401k, you have to put in your account now in order to be pre-approved. You just need to know where they're coming from, so this way the financial institution can do their due diligence. And based on all those components, that's what a loan approval is based off of. If you follow those 3 steps, if you know exactly where you are with income, you know exactly where you are with credit, and you know exactly where you are with assets, 10 out of 10 times, you will have a clean pre-approval. Now that you're equipped with the knowledge of what lenders are looking for when it comes to the pre-approval process, I hope that you have a safe, continuous year. You do make homeownership your prerogative inside of 2020. Don't let fear hold you back. If you guys have questions, please feel free to reach out to me or leave them in the comment section. I'm here to help. Talk soon.